At money market funds, a very interesting topic. I hope that you stick around up to the end because today we have a very interesting topic. Um, we have prepared a very comprehensive beginner guide, and from my whiteboard, you can see our topic covers the following. Because we wanted it to be comprehensive, we shall look at structure of money market funds, the money market fund ecosystem, performance of money market funds, reasons for investing in money market funds, how to choose a good money market fund, how to join a money market fund in Kenya, and finally, strategies for capital growth and discipline. But first things first, let us understand what money markets are. So basically, um, at the moment in our country, money market funds are one of the most popular investment vehicles today in Kenya. And why is this? This is because they invest in highly liquid securities like cash equivalents, government securities, and highly rated debt-based securities, therefore having a high degree of security. Money market funds also offer high returns to investors as compared to traditional savings account. Let's go to module 1 and look at the structure of money market fund. This is where we shall look at what money market fund is. So basically, a money market fund is a unit trust fund. And what's a unit trust fund? Unit trust funds are investment schemes that pool money from various investors and are managed by professional fund managers who invest this money that has been pooled. Money market funds are managed by professional fund managers who invest this money that has been pooled together in the funds in different asset classes. These asset classes are commonly referred to as money market instruments. And we normally have three, and from our display here, you can see them. We have commercial paper, treasury bills and bonds, and also fixed deposits. Two of these you might be aware of them, but let me explain. Now, commercial papers are normally issued by corporations to finance their short-term cash flow needs. For example, if either Kenya Airways, Bamburi, a number of banks or KEBS, whenever they want money to run their program, they issue commercial papers. So whoever buys these commercial papers gives them money to fund their projects, and by so doing, they will get money which they will pay later on at an interest. Now, this is where money market funds are invested. Treasury bills and bonds, this one occurs when the government borrows from the public. This is a common scenario. Like at the moment, the government has got a lot of projects, so it borrows from the public, and one bucket from which it borrows are money market funds. And then fixed deposits. This happens in banks. Whenever someone goes to bank their money, they put in a fixed deposit. So this is also one of the places where money market funds are invested. Looking at it in a simpler term, in a simpler manner, money market funds can simply be explained like a big pie. By buying units of money market fund, you are in essence just buying a piece of the pie. And that pie comprises of the above three: the commercial paper, the treasury bills, and the fixed deposits. This therefore qualifies money market investors to be called a unit holder. So whenever you invest in a money market fund, you are basically a unit holder. That marks the end of the first module. Let's look at the ecosystem. And in the ecosystem, we look at what comprises the money market fund, who is responsible in the daily running of the money market fund. And yes, that's okay. And we have the following. There are four parties that are involved in the money market fund. Party number one, these are professional, a fund manager. Now, who is this? this is the company that's registered and regulated by Capital Markets Authority, CMA. Capital Markets Authority controls and regulates money market funds. For example, Cyton Investments, that's an example for a professional fund manager. Now, the manager is responsible for coming up with the investment portfolio and investing the investors' funds according to the investment objectives. Another person in the ecosystem is the custodian. Now, who is this? This is the bank. This is the bank that the investors send their investment sum, and it holds the investment sum on behalf of the investors. And once the fund manager makes an investment decision, the custodian releases the money, and this money is invested per the fund policy. Then another party is the trustees. Trustees, they majorly look out for the investors' interests. They make sure that investors' interests are not violated. And so they hold the fund manager and the custodian accountable and act as whistleblowers should they suspect fraud or any problem. Take care of this, understand this ones well, because they are going to form one of the reasons why I advise people to invest in money market funds. Then another person involved in the ecosystem of the money market funds, this one is the auditor. As the name suggests, the auditor audits or reviews the fund's financial statements, which are then used by investors to assess the performance of the money market funds. So you understand that because of these levels of security, the 4 levels of security, they make money markets a low risk investment venture. Therefore, when deciding to invest in a money market fund, you should always pay attention to who are these various service providers, these people in the ecosystem, who are they? And therefore, it will form a very good basis for you to invest in a money market fund. Let's go to module number 3, performance of money market funds. And in the recently, money markets have been doing well, and so they are a great avenue to invest because, number one, as I've talked about safety, the safety that they provide to your investment. Because of that level of security, they provide safety for investment. Number two, they provide liquidity. Basically, liquidity refers to the extent to which funds that have been held can be accessible, converted to cash and accessible. So money markets are also highly liquid, and then they also give high returns as compared to traditional accounts where you just save and you have a small return on investment. Money markets have been known to have a relatively higher rate of returns. Actually, as we are speaking right now, the return is projected to is around between 10 and 11% per annum. So you realize that it's a very good return rate as compared to banks, which are at 6%. It's also higher than the rate of inflation, which is at 6.5%. Therefore, investing in a money market fund relatively gives you higher returns as compared to any other kinds of investments, as we shall be comparing. Now, why invest in a money market fund? People keep asking this. There are so many reasons why money market funds are advocated for, and why personally I advocate and tell people it's good to invest in money market funds. And so before we look at reasons why you should invest in money market fund, this is a point where I ask you to kindly subscribe. If you continuously find this content useful and helpful to you or to any other person that you know, please click the subscription button, like, and follow us for more good videos, good content, quality content. Right. Let's look at the reasons why you should invest in money market fund. And number one reason is money market funds, from where you can, as you can see, they have a scope of good return. I've already mentioned that they are already doing 11%, and 11% is higher than most banks. So these fund managers that we talked about, there are various options to invest in the money that has been pulled together. The portfolio gets diversified, resulting in money market funds uh, generating equitable returns. Therefore, one good reason why you should be investing in a money market fund is the 11%. 10 or 11% is variable. I don't want to be fixed because it keeps changing. But as of the time of recording this video, the rates are 11%, which is a very good rate. This means that if you invest, and this is per annum, 11% per annum. If you invest 1 million, after 1 year, you will have 1,110,000, close to that. And then it keeps compounding. The interest keeps compounding, implying that the interest that you earn next time will be compounded from the previous principal plus interest. We'll do that calculation sometimes later. The number two reason why I should be investing in money market funds is liquidity. We've talked about this, that because money market funds invest in short-term securities, the money can easily be accessible to the investors. So investors can easily, if you want a withdrawal, you can easily access your money without, we just give a 2 or 3 days notice, and then your money will be available. Reason number three why you should invest in money market fund as early as today is regulatory oversight. We have said that money market funds are regulated by Capital Authority, CMA, Capital Market Authority. This ensures that the investments are made under scope of the law, so that at no point will the managers of money market fund decide to invest outside the law. And this just ensures that security of your money, security of your investment is adhered to. Understand that the function of the fund manager, the custodian, and the trustee and the auditors, those that we have talked about in the ecosystem, their functions are separated. This contributes to the security of your investments, beside making money market funds low risk investment. Capital Markets Authority ensures that all the operations of the money market funds are compliant with the guidelines that have been laid out. And just this protects the investor, protects your investment, to make sure that the money that you've invested in a fund is safe, and of course growing and multiplying. Reason number five, low minimum investment amount. You understand that money market, you can invest as low as 1,000 Kenyan shillings, and this is available, this is accessible to many people. A good number of people can quickly afford 1,000 shillings, and therefore it's very easy for you to invest in a money market fund as compared to other investments, like for example treasury bills and treasury bonds, whose initial investment requirement is a bit high. 1,000 is affordable. 1,000 can be accessed by many people. Another reason why money markets are advocated for, because of the low cost of investment or the low cost of operations. Now, why is this so? Due to large amount of funds that the fund manages, very low costs accrue per investor. The fund achieves economies of scale in research, transaction, and investment, because the fund transacts in billions and millions of money. If you invested there 1,000 shillings or 2,000 or even 100,000, the amount that will go to cater for research, transaction, and all those other costs is very minimal. Therefore, not a lot of your money that you've invested in will go into transactional costs, as it would have been when you are investing in a bank or at other institutions. Reason number 7 is diversification. Investors in money market funds can access a broader range of securities than they would when investing in their own. A common investor has a limited money which he can invest only in a few securities and faces a lot of risks. But when pooled with in other investors' funds together, it can be spread out over other companies. Now, because we have so many of people pooling their money together, money market funds are able to diversify because they have a lot of money, so they can easily invest in a particular investment. For example, we've talked about deposits, we've talked about bills, treasury bills and bonds. So they have a variety of channels where they can invest, and this diversification ensures that the returns are high and risks are low. Number 8 reason why investing in money market funds is advocated for, and why I advocate for, is, listen to this carefully. We struggle with nurturing a saving culture, and therefore money markets help in cultivating that saving culture. For people who lack or they struggle to have that saving culture, making constant top-ups, because basically in money markets, after you put the initial amount, you are advised to put small top-ups frequently. So it slowly enables you to cultivate that saving culture, which is a good thing, and it will help your money grow. And at the end of the day, you're able to nurture a discipline, a saving culture discipline. Reason number 9 is compound interest benefit. Money market funds are compounded. We have got two types of interest. We have got simple interest and compound interest. But for money market, the interest is compounded, meaning that if you once you earn an interest, that interest is added to the principal so that you get an amount. When interest is calculated the following year, your amount is the new amount now will act as your principal, implying that when the second year starts, you get to have a higher amount even as compared to the initial amount, because the interest that you got previously was added to the principal that you invested in to get an amount. So when year 2 starts, it's now the amount that closed the year for the previous year now will be used now as the principal for the new year. So you realize that the amount that you invested keeps growing constantly year after year. And then reason number 10 why you should invest in a money market fund, because of retirement saving plan. If you retire, you are no longer in an active employment. So it most likely the salary that you've been getting won't be coming. So you have to get a reliable place where you put your money, and every month you be getting a constant income, just the same way like you are when you are employed, so that you are not disoriented. You are not going to work, there's no money, and that kind of inconvenience that you can get if you won't have invested in a money market fund. Therefore, those are the 10 reasons why you should invest in a money market fund. So let us check what should you look for when choosing a money market fund. Given that there are so many money market funds currently in the country, so many providers, what should you consider when looking for one? Reason number 1, past performance of the fund. It's paramount that you check how has this fund been performing, and basically it's in terms of ROI, return on investment. If in 2020, for example, the rates were 10%. In 2021, the rates were 9%. In 2022, 8%. You realize that this is a money market fund whose returns are decreasing, but you want a fund where the returns are increasing. So consider the past performance of the money market. Number 2 consideration is the minimum investment. As much as there are those money market funds that require a low investment like 1,000, there are still others that whose minimum investment requirement is large. So it's advisable that you look for one with the minimum investment requirement that you can easily afford without much strain or struggle. Then consistency. Reason number factor number 3 is consistency. I've talked about the percentage, so you need to check and realize what is the percentage and is it consistent. If it's 11, is it 11%, 11%, 11%? If it's 10, is it 10, 10, 10? It will be better than having a money market fund that whose today is giving out returns at 20%, tomorrow is giving at 9%, the following day at 15%, the following day at 5%. So consistency is paramount. Factor number 4 is regulatory compliance. Understand that every money market fund should be regulated and approved by the Capital Markets Authority of Kenya. Regulatory compliance ensures certain level of oversight and investor protection. So always make sure that the money market fund complies with the Capital Market Authority. Another factor is investment objectives. As an individual, when you're investing, you have personal objectives. And a quick note, whenever we help clients with building investment portfolios, investing in money market funds, investing in treasury bills and bonds, we do the research. That's what, if you want a more personalized package or a more personalized service, just get in touch with us. We help you create an investment objectives, and we help you we work with you the journey of investment, creating an investment portfolio and advising you accordingly on what you should invest, because this is something that we have done for quite some time. We know the risks, we understand the risks, we understand the do's and the don'ts. So should you want a more personalized service, one that suits your particular needs, please don't hesitate to get in touch with us, and we'll make sure that we help you along your investment journey. So that was factor number 5, investment objectives. Understand what you want, and based on what you want, what does the money market that you want offer? If these are in line, then you are good to go with that particular money market fund. Another factor is risk assessment. Understand your risk tolerance. Risk tolerance in investing refers to how much money are you willing to lose. As much as we are saying that money market funds have low risk, there are some other external factors that might affect you, how much rate they pay you with. Factors like quality of their underlying assets, fund size, funds operating history, and return analysis. So these are some factors that may affect the risk assessment. Then another factor is accessibility. Evaluate the ease of accessing your savings or investment in terms of topping it up or withdrawing from the money market fund. How easy are you able to access your fund? That's one of the other reasons, factors that should be considering when selecting a money market fund. Others you can be accessed, your money can be accessed through the phone, while others you have to go maybe to the bank or over the counter. So you should be considering such like factors. Minimum investment amount, I've mentioned this. And then the second last one is digital integration. Consider your preference regarding the use of physical paperwork versus a fully digital management system when interacting with the fund. Can you access everything on the dashboard of the platform, or are you required to go physically and visit the office for you to have certain services executed or done for you? Then the last reason, number 6 or 7, and the last factor, your investment objectives. Determine your financial goals and whether the fund aligns with them. Consider factors like capital preservations, liquidity needs, and the desired returns. I've said it before that when you are creating an investment portfolio, or when you're putting your money somewhere in an investment fund, you have objectives, and one of the objectives might be something like capital preservation. You just don't want to lose your money. If you're investing 10 million, for example, you always want to have your capital preserved at 10 million. Then liquidity needs. How frequently would you like to access your money? Would you like your money monthly or weekly, or how easy are you able to access your money? Then the last one is the desired returns. What do you foresee at the end of your investment period? What do you want to achieve? Do you want your investment doubled, tripled? Do you want your investment? Are you investing because of your family, because of your siblings? So many reasons. What is your desired returns after the investment? How do you join a money market fund? We are on the second last module. Sorry. Let me fix this. How do you join a money market fund? Step number 1, understand the money market fund. Like what I'm taking you through, what I'm teaching you. Get to understand all the nitty-gritties of the money market fund, so that you know how much you are investing, you know how much you are expecting, you know who are the managers are, you know who the auditors are, you know who the custodian are. Being in light will help you make informed decisions. Number 2, approach. How to join. Step number 2 is that you research the funds. Explore reputable fund management companies, comparing factors like performance and fees. I've mentioned this. Step number 3, you choose a fund. After comparing a good number of those companies, or you get to choose one. You select one that aligns with your goals and risk tolerance. Step number 4, you open an investment account. This is just like the way you open a bank account. You provide personal information, identification documents to the chosen fund manager, and your account will be opened. Step number 5, you fund your account. Now that you've opened your account, you need to have money that you are investing. So that's funding. So you fund your account. Whether you're starting with 1 million, 100,000, 50,000, you fund your account. Then you submit the investment instructions. What are these? You specify the amount and frequency of contributions with options for automatic reinvestment. How much are you putting in upfront, and what is the frequency? Will you be topping up monthly, weekly, bi-weekly, quarterly, like that? And step number 7, you just monitor your investment. Keep track of the account performance online or through periodic statements to ensure alignment with your goals. Remember, we talked about accessibility in our previous module. How easy are you to access your statements and transactions? So that's where the monitoring comes in. The last step is you redeem your investment. After you've been investing for quite some time, your returns have grown, or they have multiplied, and you redeem your investment. Enjoy the liquidity by redeeming your investment within a few days if needed, contributing to a secure financial future. Now that you have been investing, your money is there, and you can easily access it anytime, whenever you want it. This gives you financial freedom that we are talking about. We move to the last module, strategies for capital growth and discipline. Now that you've decided to join a money market fund, you've done your research, you've settled on a particular fund manager, you've already invested. What is it that you can do, strategy that you can use, so that you capital continue growing and you still stay to be disciplined. So I have them into two. Number one is strategies for capital growth, and then number two are strategies for discipline. Number one strategy for capital growth is diversification. You're advised to invest in a variety of money markets to spread the risks across different sectors and issuers. Why is this so? This reduces the impact of poor performance from any single fund. Sometimes a single fund might not perform as expected. So if you have diversified in various money market funds, you'll be cushioned in that time or in that period where one money market fund would be performing well. Strategy number two is reinvestment of earnings. At the end of every month, I forgot to note this. Money market interests are calculated on a daily basis, but deposited in your account at the end of every month. So you will always be having interest at the end of the month. So it's always advisable that this interest that you get, do not withdraw it out. Instead, plow it back. We are calling it reinvestment of earnings. So reinvestment of the interest earned from money markets funds to take advantage of compound growth, and this will significantly enhance the capital growth over time. Someone who consistently tops up the account and never withdraws, after 1 year, they will be miles ahead as compared to someone who kept withdrawing their interest. Strategy number three is known as laddering. Laddering strategy helps to manage interest rate risk and ensures liquidity at regular intervals. What is this? Laddering basically means that you invest your funds in money market funds that matures at different levels. For example, you'll invest in a fund that matures in April, and you invest in another one that matures in November, and another that matures in January. Spreading it out is known as laddering, and this helps to manage interest rate risk and ensures liquidity at regular intervals. Strategy number four is regular contributions. And this is just a discipline matter. As you continue to be disciplined and you continue contributing your contributions regularly, your capital grows. And it can be predictable because you are also predictable in how you contribute. So your capital can also be predicted because it grows uniformly. So make a purpose of contributing regularly. This can be through checkoff or can be through just being disciplined. A standing order from the bank where money is directly deducted. And then the last one strategy is monitoring and rebalancing. You are advised to regularly review and adjust your money market portfolio to ensure it aligns with your investment goals and risk tolerance. What are some of the strategies that will help you to be disciplined? Strategy number one, setting clear goals. From the word go, define your investment objectives. What do you want to achieve with that particular investment? Is it capital preservation? Do you just want to retain your money and not lose it? Is it income generation? We've talked about someone who is about to retire. Do you want to constantly be getting that income, or do you want your money to grow? These are some of the goals that you need to have when you're setting up your money market fund or when you're making your decision. And remember, I talked about this. We help you to set some of your financial goals depending on what you want. We sit down with you and help you to set these goals clearly before deciding on which money market fund to invest in. Another strategy is risk management. Assess your risks, your risk tolerance, and invest accordingly. Money market funds are generally low risk, but understanding your risk appetite helps in maintaining discipline during market fluctuation. So it's important that you understand your risk tolerance, and this will just help you to maintain a discipline during any time that we have fluctuations. Strategy number 3, under discipline, that stick to the plan. Develop either a written investment plan that outlines with your strategy, with your goals, and your risks tolerance, and stick to this plan. Avoid impulse decisions based on short-term market movement. Market will always evaluate. It's beyond your control. But the moment you have a plan, you stick to this plan so that should the market fluctuate, you are not bothered by that. Second last reason is education and research. Continuously keep learning, continuously keep checking like what's happening in the news, in the economic news, what is happening. Be informed on what's happening. What are the factors that might affect your investment? What factors will boost your investment, will make your return on investment go high or go low? Knowledge helps in making informed decisions and maintaining discipline in investing, in saving, in budgeting, in all these aspects that deals with personal finance. Professional advice, talk to professionals, like that's our work, that's what we do. Whenever you have to make a finance decision and investment decision, then avoid emotional decisions. We've talked about market fluctuating. So whenever these markets are fluctuating, you're advised to just avoid emotional decisions. Money matters doesn't want emotional decisions. Sometimes the market will be volatile. So avoid making decisions, irrational decisions, based on how the market is as at that particular time. Then finally is automatic investment plans. You're advised to have automatic investment plans. Those, when you decide to make an investment, let it be automatically checked off. For example, if you are employed, let that be a check off. Or just before you access your money, let there be a standing order from your bank, so that your money is directly directed to your investment portfolio before you access that money. And this will just help you to maintain discipline during investment period. This will ensure that you do not miss any contribution. Understand that if you have cash and something happens, an emergency, you'll end up using that money to cater for the emergency, other than having it directed to the rightful place. And that marks the end of our lesson today, money market funds. If you find this useful, again, please subscribe to our channel and share this to anyone who might find it useful. And thank you for watching, and leave a comment under there. Should you want to make more inquiries, should you want to engage us for trainings or coaching, or you just want to learn more, you want a more personalized a plan that suits you, get in touch with us and we will help you.